So the next big part will be about intraday trading. I'll be showing a lot of trading approaches, a lot of trading strategies, but before that, I'll do a little introduction to intraday trading. I'll start with the definition. It's not a clear definition, it's only a rough one. I came up with this one, so it may not apply to all cases, but this is how I would define intraday trading. So probably the most defining thing for intraday trading is that trade entry and trade exit occur at the same day, which means that you don't hold to a trade overnight. This is in majority of cases. In some cases, I do hold trade overnight, but usually the trades start and end within one day, all right? The trade can last few seconds, few minutes, or a few hours, but usually not more. As far as time frames concerned, it's usually from 5-minute charts to 60-minute charts. This is not a hard rule, this is just how I see it. Of course, you can do intraday trading with tick charts or with 1-minute charts, but I wouldn't really advise to do that. And for that reason, the preferred time frame, at least for me, for intraday trading is 5-minute to 60-minute charts. Now, because you want to be quickly in and out of the trade during one day, you need to set your profit target and stop loss accordingly. And the maximum value of the profit target or stop loss should be around 20 to 25% of average daily volatility. This is the maximum. You can go, for example, to 10% to 25% of average daily volatility. All right. You can measure the average daily volatility if you use the standard ATR indicator, and you can measure it. Alright, so let me quickly show you how to measure the volatility using the ATR indicator. So this is US dollar Japanese yen chart. It's a 30-minute time frame, and now right click the chart, you go to indicators and you search for ATR, which is in here, double click it, and you set the period for a higher number, let's say 200. Alright, apply it, and in here you can see the average volatility. As you can see, in this case, the average volatility is somewhere from this place to this place. So it's roughly 67 pips per day to around 90 pips per day, right? 67 to 90. So currently, in this period, the 10% of the daily volatility would be 9 pips. All right, if you wanted to trade 20% of the daily volatility would be 18 pips, which would mean that your take profit would be 18 pips and stop loss 18 pips. All right. Those are just rough numbers, but I wanted to show you how you can set the intraday profit target and stop loss for your trades. All right, so this is the ATR indicator. To smoothen this line a bit, it's better to use a daily chart. And also, you can go back to the indicator setting, and you can use higher period, for example 400. Alright, so as you can see from the longer perspective, the ATR is dropping, the average volatility is dropping. It's caused mainly because of this crazy spike. This is not really usual, so you won't usually see such a rise, such a rapid rise in volatility. Alright, so it's quite safe to say that the average volatility is somewhere between 63 to, let's say, 66 or 70. It doesn't really matter, it's just few pips. Alright, so this is how you can set the profit target and stop loss for your intraday trades. So for example, right now I'm using 10 pip profit target and 12 pip stop loss for most of my intraday trades. And as you can see, this is very roughly a little bit below 20% of average daily volatility for the US dollar Japanese yen. Alright, so let's move on. Here are some pros and cons for intraday trading. The pros is that you are fast in and out of a trade. You can have a lot of trades in one day, which is kind of cool. You don't really need to wait for too long for trades, especially if you analyze a lot of markets. There's no overnight swap, which is quite handy, because you are not losing money when you are holding your position too long. And as I already said, you are having more trades, so you are having fast trades and you are having more trades. And this is probably the most appealing for most of people, because they like to be fast in and out of a trade. A lot of people are not really comfortable holding trades for days, alright? They just can't do it, or they don't really feel good doing it. So they prefer being fast in and out of a trade, so they don't feel the pressure when they are holding their trades too long. The cons of the intraday trading is that the lower time frames, for example a 5-minute time frame or a 15-minute time frame, are sometimes harder to read than higher time frames, like 4-hour time frames or daily time frames. There's a lot of noise on, for example, 5-minute chart, and a lot of people can't really see through the noise to see the bigger picture, to see what's really happening. So there's some noise on the lower time frames, which simply isn't on higher time frames. Another disadvantage is the macro news, because when you are trading intraday trading, you need to be extremely careful when there is macro news. You need to quit your position, you need to manage your position. You can't just leave it open during macro news. Alright? So this is what you need to keep track of. Macro news, very important thing. Another thing that people don't like about intraday trading is that it's time consuming. You just need to be at your computer much more than if you were doing, for example, swing trading. It's much more time consuming. So now I'm going to talk about what markets to trade for intraday, what markets to choose for intraday trading. The first rule is to go for liquid pairs. You can tell that trading instrument is liquid when it's popular, when a lot of people trade it. Advantage of a liquid market is that the risk of getting slippage is quite low, and also the liquid markets usually have low spreads and low commissions. This is quite essential for trading intraday trades. As I already said, another criteria is that the instrument you want to trade needs to have low spread and low commission. This is really essential when you want to trade intraday trades. It's not as essential when you trade swing trades or when you are investing, but for intraday trades, this is very important. The ideal markets to trade intraday are futures, like indices, energies, metals, currencies or bonds, then forex, and also stocks. Well, talking about futures, then the most popular for intraday trading is, for example, the oil or the Standard & Poor's index, DAX index, Nasdaq index, or gold. Those are the most popular. When you trade forex, it's very important to trade only the major pairs, which are the pairs that contain US dollar. For example, US dollar, Canadian dollar, US dollar, Japanese yen, Euro dollar, Australian dollar, US dollar. Alright, those kind of major pairs. And as far as the stocks are concerned, then you definitely need to trade big stocks. You need to day trade big companies, not small ones. You need to have liquidity. So you want to choose stocks from big indices, like stocks, for example, from the Standard & Poor's index. Alright, so if I go back to the chart and in here, then here is the SP 500, and those stocks are all big stocks that are all in this big world index. Alright, so those stocks are good to trade intraday because they have good liquidity. They are big stocks, big companies. So if you want to day trade stocks, you definitely want to stick to big stocks like these. So the last thing I want to talk about in this video is the Forex versus futures. because there's quite a difference between Forex and futures. The most significant difference here is that Forex is decentralized market, whereas futures is centralized market. What this means is that when market is decentralized, every broker gives you different price and different volume data. It's not centralized. The data is not centralized for everyone. With futures, on the other hand, it is centralized market where everyone has the same price and volume data. Everyone sees the same price and volume data. So this is the main difference between those two. Usually people think that this difference is really big and that they need to trade futures, but I compare Forex and futures every day, and I must say those are very close. Especially if you choose a big broker like, for example, FXCM for your data feed, then the volumes which you will see will be very close to the futures. And also the price movement will be very close. There is a almost 100% correlation. So what I actually recommend is just go for Forex and do your analysis there. It's not that different from futures, even though the Forex is decentralized. Alright, the next difference is that Forex is a little bit cheaper to trade. It's also easily accessible for everyone. There are brokers everywhere. They are competing. It's very easy to set up a Forex account and start trading. And it's also easier and cheaper to get Forex data. Usually brokers give you that for free. Whereas for futures, well, in this case, sometimes you are limited. Also, one more thing which I would like to point out, that some currency pairs are reversed. So for example, US dollar, Canadian dollar is Forex, whereas on futures, it's Canadian dollar, US dollar. What this means is that, for example, if Forex goes upwards, then futures goes downwards. The correlation is around 100%, I should say minus 100%, because the price goes the other way, but otherwise it moves the same. And this can actually be another disadvantage. If you, for example, want to do your analysis on futures, but then you want to trade on Forex, then you need to create your levels on this chart and then recalculate or create the same level on this chart. And this adds you extra work to your analysis. So it's just simpler to do everything on Forex. This would be my advice. If you really want to be precise, then you can do your analysis on futures and then shift your trading levels to Forex and trade with your Forex broker because it's a bit cheaper. But maybe this is just too complicated and it's better to do your analysis on Forex and trade Forex. Alright, so that's for the brief introduction for intraday trading. In the next video, I'll show you how to create an intraday trading workspace.